I want stocks to be lower, so there's better opportunity for us to be picky investors. All right, guys, Howard Marks. I love this guy. He's written a lot of great books. He's a great value investor. He looks a lot at debt. And the thing I like about him is thinks high level. He is the person I got the first level investor versus second level investor. What that is a first level investor thinks, okay, this is a great investment. I'm going to go buy it. The second level investor will sit there and say, if everybody thinks it's a great investment, it's probably getting overpriced and therefore I shouldn't buy it. So this is a reaction video about his sea change he's talking about, historic sea change. And this is about 4.5 minutes. I don't know how much we're going to get through, but Mo and I will watch this and we will react accordingly to it and go from there. So let's press play.
Fresh off that memo everyone's talking about.
Thank you, Sarah. It's nice to be here.
It's good to have you, and happy holidays. So let's start with the sea change. That was the big headline from your report. It's how you kicked off your memo. You said 53 years in your investing career, there have been 3 sea changes, and we are in one of them. Okay. What does that mean?
Well, a sea change is a major transformation of the environment, a complete change in attitudes, et cetera. And I suspect that we may be at the beginning of one. The first one was the fall of interest rates from 20 to 0 between 1980 and 2020, which had very, very positive effects. The second was the opening of investors' minds to what we call risk-return analysis. And before the 70s, the job of the investor was to avoid risk. After the 70s, it was to intelligently take risk, and that was a big change. And I think that we may be on the doorstep of the third.
So what is the sea change?
Well, you know, since the Fed, central banks around the world, and the Treasury took strong action to solve the global financial crisis in 08, 09, we have been living in a highly stimulated, very positive, easy money environment for roughly 14 years. And I think that, you know, a lot of people began to invest or came into the business in those 14 years. Not too many have a perspective on the period before the global financial crisis. And they may think that the last 14 years was normalcy.
Okay.
Yeah.
So Mo here is a young lad. Mo didn't experience anything before the financial crisis.
No.
So this is part of what I've talked about, and we're going to do a video at some point here about bubbles. And so first off, he's right. 1980 to 2020, when you see interest rates go like this, guys, what happens to asset prices? It's much easier for asset prices to go up, okay? Because interest rates essentially the cost of money. And as interest rates go lower, people have a more willingness to take on risk because, hey, if I can give the government my money for 10% a year, why would I go take on a risk of an equity? Makes absolute perfect sense. You know, he talks about before the 70s, the gold investor was to be risk averse. Before 2000, the market got overpriced was, you know, late 60s and the Great Depression. And since then, we've had 3 market bubbles that have all been above all 3 of those. And that kind of makes me go, okay, I do believe in taking smart risks and being smarter about how and this is part of my dynamic change, right? In terms of how I look at investing. We do it with our real estate. I have no problem paying full ask price for a piece of real estate if I see, and I've done this before, if I see the value there that hopefully somebody else may not see or may not want to be as aggressive about. This sea change memo, ironically, when I read it, I really didn't get it at first. I'm like, wait, because even when he answered the question, he didn't really just say,
super clear about
he's not just saying, is the sea change that, okay, we've had 14 years of this major expansion of, you know, multiples and people think it's easy. Are we now going to have a new sea change where rates are going up along with people not being used to not seeing major growth in their investments, right?
Yeah.
I think that's the sea change that he's discussing. And if he's not saying that, that is to us what we've been talking about on this channel for a while. When the average person is easily making money by investing in random things, when you see David Portnoy, Davey Day Trader, making money just random, he was on a date and a girl mentioned a stock, he went and bought it, made a couple $100,000 on it.
Yeah, it's not normal.
Does that mean you can't make money? No, it just means that the processes that worked before during bubbles don't matter anymore. Not that they don't work necessarily, but they don't matter as much. It can just be throwing darts and you're going to make money.
So I'm interested to see if this is a actual sea change. This is the third he's seen in his very long career. How long does this last?
So
that becomes the question.
A few years ago, I was talking to our good friend Michael Moskal, and I said, this is a few years ago before we even hit the recent bubble levels. I said this next bear market could be the longest one we have. I'm not saying it's going to be the worst one. I don't know what the Fed's going to do. Will the Fed start buying stocks to boost stocks up? But the last two crashes we have, COVID and the financial crisis. The financial crisis was a very quick down and then boom, right back up.
Yeah.
COVID was even faster. In 1 month, we went down 40% and we were back to normal by August, 4 months later. Yeah. And I look at that 5 months later, I look at that saying, to really get great values, to really be a true opportunity for the astute investor, you got to have everybody on the periphery out. I looked this weekend, I was tagged on Twitter. Meet Kevin said, when my grandmother thinks Tesla's never going to come back, we're near the bottom. I want to see Meet Kevin bail on Tesla. That to me would tell me that we've hit a bottom. Not when his grandmother says that. It's when the diehard fans of a company have given up. We've talked about it on this channel before. And if you're new to this channel, what we're doing here is we're trying to sit there. The numbers part of investing is easy. It's the mindset and emotion that's really going to set you apart in your ability to do well in the market. We've said that Apple would be the one that we want to look at. Apple and Tesla are the two stocks. When everybody's given up on those two stocks, we think we're probably close to some sort of bottoming out. You need to get rid of all the people who say Apple's where you go. That's the guarantee. That's where you get your money. That's always going to be safe. We believe that we need to see people giving up on Apple before. I think Tesla will be given up on before Apple will.
Seems like it. That's down another 6% today.
And Tesla is down another 6% today. By the way, I was short Tesla from about 200 to 135. And even I exited saying, listen, this is too much of a fall too quickly. Like even I'm going to say, let me take my money. Now, obviously in hindsight, I'm like, son of a.
I know I exited at like 126 last week.
I was like, son of a. And the money flow. And these are the things that we look at, the money flow index. But this sea change, I think could be the long-term. I'm hoping it's the long-term sea change. I want stocks to be lower, so there's better opportunity for us to be picky investors. You should want that if you have decades to go before you retire. Now, if you're on the cusp of retirement, maybe consider taking money off the table. But we look at valuations now, and I talk about this a lot on our chat in our community. We still look at 61% overvalued here. That's really, really high. Guys, the last time that happened was in 2000. It never even hit this level. It was like 55%, and the next 10 years was like negative 2% on the S&P. Not including dividends. So I look at these things saying, this sea change, I like this slower route. The S&P is down 20% now with today on the year, I think. I like this. And everybody's like, okay, we're not going to have. Barron's got a survey from a bunch of financial people. Not a single one estimated a loss in the S&P for next year. Not one. Could it be right? It could absolutely be right. Any given year is completely random. But when I want to look at the change, when I want to look at a deep sea change, I want to sit there and see people just saying, 1982 article, the death of equities. Mm-hmm. That's what you want to see is people saying you can't make money in stocks. When you have kids, teenagers, people in their 20s just thinking, oh, okay, well, these stocks can't go down a ton. Well, they are. I mean, look at Tesla. It's already down from a high of 414 to 115, and that's in the last year and change, right? Yeah. That's a big drop.
Year to date, Tesla's down. Is it 70% now?
Oh, it's definitely over
71.07% as of right now.
What's the all-time high? 414 on November 4th, 2021. That's 13 months ago, guys. 13 and a half months ago. 13 and a half months ago, it was at 414. And guess what? We think it's going to go down further. We really, really do. And it might seem crazy, and there might be a bump up along the way. There might be a late Santa Claus rally. We don't know. We don't know what's going to happen on any given basis. But our job, it's like Howard Marks. Howard Marks said a brilliant thing in a podcast. I listened to him once. He said, listen, I didn't have to know about subprime mortgages and credit default and CDOs in 2006, 7. I just had to look at people's behavior with real estate and going, there's a problem here. And that's what I like. I like looking at saying from a high level, and the thing I missed in this bubble was there was too much money on the sidelines. And to get to this irrational level, you had to have, the analogy was, and this poor kid is sitting out there, When I went to play golf at Firestone Country Club, my caddy said, hey, I know you. You're on that channel. He's like, yeah, you're wrong on Tesla, Bitcoin, and Palantir. That's what I heard that going, oh my God, a 17-year-old kid follows that idiot in Russia or Israel, wherever he is, and just thinks, and since then, what have those 3 assets done? And they're probably going to get worse. And they're probably going to get worse. Now, the difference between us and him is we are now interested in Palantir, and we're starting to get interested in Tesla because, wait a second, this is starting to fall to our levels here. We got to start paying attention. I'm still not a buyer of Tesla, but I guarantee you I will be at some point in the future. So guys, Howard Marks is a brilliant man. He's all about patience. He loads up his gun. When he's ready to pull the trigger, he pulls the trigger. He's a debt guy, though. What he does is he likes to buy debt from things and invest in debt that's been already beaten down. So if this all makes sense to you, I hope it does. Follow the channel, subscribe to us. You're going to love it. And if you like our software from our other videos, everythingmoney.com, 100% money back guarantee after 30 days. If you don't like it, just email us. Thanks very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?